Hey, listen, you know what? I promised you that I'm going to be making practical videos, calculating those numbers to know what exactly are you going to earn if you invest here in comparison with the other one. And the journey continues. And by the way, thank you for your eyeballs and thank you for always clicking on this video and making sure that you watch my videos. And by the way, if you've been watching my videos and you have not subscribed, go ahead and that small button written subscribe, go ahead and hit it. It's a black in color, and make sure that you like the video and leave me a comment on the comment section. Ask me that question that you want me to address and I'm gonna head and do that thing. By the way, this question I've actually picked it from the comment section, so leave your question out there, explain it briefly how you would like it to be addressed, and then I'll make a video about that. So today we are comparing, if you had yourself 1 million, would you go ahead and do it in a fixed deposit, say in a bank, or would you go ahead and invest it in a money market fund? Which one gives you the better return, and which one would I recommend? And that is exactly what I'm going to address on this, and I'm going to use the simplest language for you to understand. All right, let's get into the business now. Here you are, you have yourself 1 million that you want to invest, because you've been listening or watching good Joseph, and of course Joseph has been saying don't put your money idle. Make sure that you put your money somewhere where it's earning you something, and you're caught in between. Should I go ahead and fix it, or should I go ahead and do what? Put it in a money market fund. Now, let's dissect each and everything. By the way, if you didn't know, there are two types of fixed deposits. Okay. Can I say two types? Let me just say there are two. Let me use that term. There are two types of fixed deposit. There is that fixed deposit that you probably watching me as a commoner, or a normal, in Kenya we call them normal mwananchi, like that fixed deposit that you get once you show up to a bank and tell you, hey, we have a big fixed deposit here, blah, 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 that kind of a thing. So we have the common fixed deposit. We have the common fixed deposit. Are we together? Or FDS, however you're going to call it. And then we have highly negotiated fixed income or fixed deposit, or however you're going to call it. By the way, did you know this? The way you can go to a bank with the money and negotiate for a fixed deposit is different from the way an institution that can go and negotiate. For example, a money market fund institution can actually go to a bank and negotiate for a fixed deposit. And of course, they're gonna get better returns. But you, just a commoner, a banker who keeps the money in a bank, it's something like that. The fixed deposit that you're gonna be given, of course, you know what the amount of money or in terms of the interest rate they're going to give you out there. So there are two types of fixed deposits. That one you're supposed to understand. And I want to give you a very quick example. Have you ever gone to a bank? And please, if you want to prove whatever I'm telling you, do this. Have you ever gone to a bank and ask them, you guys, I would like to open a money market fund. I would love to invest my money. They hardly take time before they accept. They actually take you in, in what do we call it? They take you rounds and rounds and rounds. They tell you, oh, you know what? In place of that, we have, I don't know what type of account. I don't know, we have a fixed deposit. I don't know, we can do this. You know why they're doing that? Because the moment you go the money market fund way, they have lost that money. They have lost that gig. You are going to get better returns. You are going to get what we call, like, they no longer have that particular money. But when you give them, then they fix it for you, then they invest. You get out, they are winning at the same time. And if you've ever tried this, go check your bank. So there are two types of fixed deposit. There is that what is given to commoners, and then there is that what we call the highly negotiated fixed income or fixed deposit, or however you're going to call it. Now, you have yourself 1 million, you want to go ahead and deposit it, or you want to invest it. You're caught in between. Now, which one gives you high returns? In Kenya, and I stand corrected, as of now, I'm making this video of 2024 at around 28th of October is when I'm making this video. If you go ahead and ask for a fixed deposit return, averagely in any Kenyan bank, they actually plays around 6.5% all the way to around 8.5%. 8.5%. That is what they give you for what we say fixed deposit. And remember, this amount of money, or this return that they are giving you, all this is actually pre-tax, meaning it is before tax, because you have to pay tax. It is before tax. So these returns, you have to deduct the taxes, because you have to pay tax. Okay? Now, the question is this. Let's calculate, me and you. I got myself a calculator here. Get yourself. You can pause the video, grab yourself a calculator, and when we do the mathematics, you take your million, you go ahead and fix it. Okay, because hey, you don't want, hey, you say fixed deposit safe is whatever, so you take your million, you go ahead and do what? You fix it. Now if you want to fix it, then it will be what is, let's even say they're giving you 8.5%. Okay, what is 8.5% of 1 million? What is 8.5% of 1 million? What is it? It is equivalent to 85,000. And remember, when we say it is 6.5, we always refer per annum or per year. Are we together? So whatever is, I'm saying 6.5, 8.5, it is per year. So it give you, the 1 million bob, you fix it in a bank, it will give you 85,000 because you're being given 8.5%. That is the amount of money that you're gonna get. But don't forget, this 85,000, it is pre-tax. Tax has not been deducted. In Kenya, it depends with your country. In Kenya, we usually pay taxes of 15% of whatever you earn as an interest, not the principal. 15% of whatever you earn as an interest, with an exemption of stocks or shares. By the way, if you didn't know, shares you pay 5%, not 15%. So it's quite an amazing area of investment, by the way, if you didn't know. If you're this kind of a guy, you don't love paying taxes, or okay, not really, you don't love paying taxes, of which I advocate people to pay taxes, but sometimes some taxes are actually so, like for example, in Kenya right now, we are being given a lot of taxes to a point whereby like we don't even have the capacity to pay all those taxes, but the taxes are being increased, but the productivity is going down. There is nothing wrong to pay taxes, but again, we pay these taxes, but you know, corruption here and there, and I think it's a thing in Africa and what have you. By the way, from the people I've interacted with, they don't have a problem with paying taxes. The problem they have is that you pay taxes, then the next minute there is a scandal. I don't know what money has been lost. Let's not get into the political way. So you have your 85,000 there, and this is pre-tax. The tax has not been deducted. Now, this is how you do it. Now, this 85,000, this is 100%. So if you want to deduct 15% of it, so you have to deduct 15% from this 85,000. So simply say, if 85,000 is equivalent to 100%, then how about 85%? Because I've already deducted what? I've already deducted the taxes. So it will be 85,000 multiplied by 85 divided by 100. Are we together? So that will be how much? So I got myself a calculator. Wanna calculate this so that we go step by step. Okay, so it will be 85,000 multiplied by 85, then that number divided by 100. That will give you 72,250. So that will be 72,250. That's what you're gonna get. I've already deducted the taxes, and if you want to know how much you have paid for the taxes, you can simply minus the 85,000. Then you realize you have paid 12,750. That's what you've paid, 12,750. That is what you have paid for the taxes. Okay, that's what you've paid. Now this is what you're gonna end up with. Now the question is, this is exactly how much you have earned in an year. That is 72,250. Now 72,250, if you want to know how much, of course, you've made in a month, then of course you're going to divide this number by 12, because a year is made up of how much? It's made up of 12 months. So it will be 72,250 divided by 12. You're going to have yourself 6,020 shilling. That's what you're going to get. Or roughly, let's say, yeah, let's call it 6,020 shillings, because even that 20 shillings matters a lot. I was about to say 6,000 only. No, it is 6,020 shillings. That's what you're going to get. Now, the question is, this is what you get monthly. This is what you get monthly. Well, of course, that money would be sent to you, or maybe say available for you to withdraw each and every month. But what I'm just trying to paint a picture is, this is what you actually gonna be making in a month. Though you're gonna get it holistically, that amount of money, say at the end of the year, if you're fixed for an year, of course, that is exactly what we are talking about. Fixing it in an year, that's what you're gonna get at the end of the month. Of course, this is what you're gonna get it at the end of the year. Okay, I've brought it to the levels of the monthly because MMF usually gives you monthly. Now we already know that is exactly what you're gonna get if you put your money in a fixed deposit. Now let's calculate if you put this money in a money market fund. Okay, we go step by step, and thank you. And by the way, if you have not subscribed, if you have not liked the video, go ahead and like the video. Okay, so let's now go ahead and check on what? On a money market fund. Let's say you've done all the research, you've actually contacted Good Joseph, you've been guided. What's the best money market fund? What are the factors to consider before choosing a money market fund? How does it work? And all those kind of things. Okay. And by the way, my number is always on the description of this specific video. Just a cup of coffee's price. I'm going to share with you everything. Now, see, you put your million into that money market fund. Now, what happens is that the money market fund interest rate, again, it depends with the company that or the company that you invest with, okay? But I would say it actually ranges from 10% all the way to 15%. Right now, let's give it a 12%, okay? Let's give it a 12%. And okay, let's give it at 14% because largely that's where the percentage is. Let's give it at 14%. Now, this 14%, I want us now to calculate how much you're gonna make in that particular year, and we're gonna do all the deductions, okay? Now, 14% now it will be what is 14% of a million, 1 million. What is 14% of 1 million? For those who know, and of course, don't forget this one is per year or per annum, depends on how you frame it. So, what is 14% of 1 million? That will be 140,000. Okay, that means this is the amount of money that you're gonna make at the end of the year. But remember, please don't just post the video and be like, oh my goodness, that's we have not yet done this amount of money. This is pre-tax. And of course, there's something called management fee. You have to pay management fees. Why? Have you ever even asked yourself, how do these money market funds make money? How do these companies make money? By the way, I'm going to dedicate a whole video about that. How money market funds companies make money. Are we together? Yes, I'm going to explain that to you. But management fee in most cases is usually 2%. If you get a good fund manager, the management fee is usually 2%. Now, 2% has to be deducted out of the interest that you make. Now, of course, you remember pre-tax or the taxes in Kenya is usually what? 15%. Check out on how it is or how much it is from your country. Now, this is 140,000, and remember, this is equivalent to 100%. So what we can do, we can actually take the 15%, which is the tax, plus the 2%, which is the management fee or how they make money, which is 2%. That would make us 17%. Are we together? Yes, let's give it as around 17%. Those are the deductions that we're gonna have. Now, let's now subtract 17% out of this. This is equivalent to 100%. Let's deduct 17%. So how do we do it? We say simple. 140,000 is equivalent to 100%. How about you take 100% divided by minus 17? That will give you 83%, if I'm not wrong. Yes, that is 83. So how about 83%? So you cross multiply. I'm simply using a high school method here. 140,000. You can have a different way of coming up with the same answer. This is like a Hess law. No matter the root of the reaction, the end result are the same, blah, blah, blah. Remember that thing in chemistry? Exactly. So now 140,000 multiplied by 83 divided by 100. So how much does that give you? Again, take yourself a pen and paper, of course, a calculator. You go ahead and say 140,000, multiply that by 83, divide that number by 100. That gives you 116,200. That gives you 116,200. All right. So basically the difference between this and this is what you've paid for the taxes. So you simply, if you want to know how much that was, you simply take that one and subtract 140,000. That gives you 23,800. That gives you 23,800. That's what you pay for your taxes. Are we together? Now, this is the difference. This is what you're going to end up with. So if you want to know how much you're going to make per month, you simply divide this by 12. If you divide that by 12, how much do you going to get? You divide that by 12, you're going to get yourself 9,683. 9,683. Remember, it's actually a little bit lower than what we calculated on a previous video because I made a video and explained to you that the money market fund returns are actually going down because of the performance of the treasury bills and other factors that I explained there. If you didn't watch that video, go watch that video, you will understand. Now, this is exactly what you get. So the question on this video was, if you invest 1 million in a fixed deposit compared to investing that million in a money market fund, what do you get? We've realized that you're going to get yourself 72,250 if you put it in a fixed deposit, but you're going to end up with 116,200 if you put it in a money market fund. So of course the answer is right there on the board. It's you to make a decision, and that's why whenever you go to a bank, you ask them about the MMF and other investment methods. By the way, even if you go there and tell them you'd like to go into the treasury bonds way and whatever, they always try to push you back or put you back towards these things, because the moment they do this, they can actually make money out of it. So it's your decision now to make which one is the best for you. But remember this is my disclaimer all the time. Make sure that you do your own research. Make sure that at least you consult your financial advisor before making any attempt to invest, so that you make what we call an informed decision. That's good Joseph speaking. For now, it's a goodbye, and see you in the next one. And don't forget, by the way, my number is always on the description of this specific video. See you there.